Okay, good afternoon, everyone. Welcome to R&D Credit Maximizer, turning Section 174 compliance into competitive advantage. I'm Jamie Sweet. I'm the Associate Director of Education and Entrepreneurship here at Pennovation Works. I'm joined by some of my colleagues from Pennovation and PCI Ventures, and we're really excited to have you all here today. We've seen how founders are challenged with the recent changes to R&D tax legislation, and more importantly, how startups are turning these compliance requirements into competitive advantages. So we're lucky to have two experts joining us today. Rick Klebin, president and founder of Sycamore Growth Group, and Steve is also here with
But
us,
also
Steve
Jenna,
Wyatt,
Jenna, our
and
tax
Jenna.
attorney, she's been doing a lot of the digging to help us navigate this new tax law and found things that none of us thought were there.
Thank you, Jenna. Yes, the team has been doing a deep dive and they're going to share their insights with us today. So before we start, just please feel free to use the chat for questions and we'll have time for Q&A at the end. This session is being recorded, and so we will circulate that video once it's live. We also have Anne Fabry on the call from MVM Associates, and I'm going to have her introduce herself after the presentation as well. So with that, I will turn it over to Steve and Rick to get started.
Sure. Can we move to the next slide?
There we go.
Okay.
Oops, sorry, I was hitting the wrong screen.
Thanks, Jamie. So I'll start by introducing just to give you a brief overview of our firm and our team of panelists that you've already halfway met. So we are Sycamore Growth Group. We're a specialty tax services firm based in Dublin, Ohio, in our 14th year this year. And our primary focus is the R&D tax credit and that portion of the tax code. So we are an inch wide and 10 miles deep, as Rick likes to say, in this area of the code. So if we can jump to the next slide. So again, we're based in Dublin, Ohio, but as you can see, our clients and CPA referral partners are nationwide. And most of them have found us through our thought leadership. As I mentioned, we're constantly researching this portion of the code and writing articles, conducting webinars like this, both private and public. A number of our articles have been published in Bloomberg. And so we've kind of gotten a national presence, through that thought leadership. And my name's Steve Wyatt. I'm the Vice President of Business Development. I've got over 20 years in the financial services sector and 12 years specifically focused on R&D credits and working primarily with small to medium-sized businesses and helping them navigate the credits. Rick Klebin is our founder and president. Rick is not only specializes in research, researches heavily along with our, Jenna and Jamie and our other analysts, but he's a huge advocate for the credit in Congress, both federally and at the state level. Is advocating for small businesses and for the credit in general. And Jenna Tagawan, as Rick mentioned, is our tax attorney. And Jamie Bean is one of our CPAs on staff and is one of our senior researchers and analysts. And Jenna and Jamie do a lot of the heavy lifting. Anytime there's new regulations or guidance issued, they're doing the heavy lifting on the research side. Our agenda for today. So we're going to talk about high level how the R&D credit works, and most importantly, for small startups, what those credits mean to you, like how could you accumulate those credits, and more importantly, how can you monetize those credits in the near term? We're also going to touch on the history of the credit and why that's important now. How the credit works, the computation, and just a general overview, what the filing requirements are, and what we've learned over the years as to the best approach to compliance and sustaining those credits should the IRS ever question a claim. As Jamie mentioned, we've left time to answer questions, so drop your questions in the chat. If they come up, we're going to allow time to address those.
So there are a couple of House bills that are of note. So a lot of our companies we work with are small business innovation researchers, which just means you're getting awards from NIH or DoD or NSF, and the acronyms go on and on. Many probably already know, but if you're benefiting from these SBIR contracts, that the program ends at the end of this month. And it's been going on for 40 years. Now it's been renewed, like every 5-ish years. This is the latest it's gone without being renewed. And at least some good news is the House recently passed, I guess earlier this week, a bill that would just extend it for a year. So just buy everybody time to come up with a full bill. And probably what happened is this House Bill 477 or 4777, it's been out there for a little while, being circulated in the House. They're trying to make a lot of changes to the program, like mandating fixed fee, which is if you're NSF or NIH, you're used to this something called cost plus. We can talk about it more in a minute. You'll know it as I get 7% fee on top of my expenses. This would change that. This would mandate that NIH gives you a fixed fee contract, which is a milestone-based contract. So it's not here yet, but that's where Congress is trying to go. And Steve, you want to speak to, whether I'm getting paid to do research? How can that be R&D, or at least R&D for the purposes of getting the credit?
Yeah, that's a question we get a lot, and happy to address that one. So, conducting R&D under a contract does not disqualify you for claiming the credit, so long as you bear the financial risk of that development and maintain at least some of the rights of what's being developed. So an example of this would be if you're in a fixed fee contract with your client, whether that be a government client or commercial client, the IRS would view you as the party that's bearing the risk that costs could exceed budget in a fixed fee arrangement. If it's a cost plus arrangement or time and materials, many times the IRS would view those as your client bearing that risk. So that would not qualify you for the credit. So long as you're bearing the risk, maintaining at least some of the rights, a government grant or any kind of contract is eligible so long as you meet that criteria.
And so some of you may say, wait, they were just talking about how they want to change this to fixed fee. Steve's explaining how that means I have financial risk. So, wow, this feels really bad. Our experience working with SBIR researchers is they say, even when I'm on a cost plus contract, many times I'll do a no cost extension where it's code for I'm paying to get the research to the finish line. And you do that either because you just really want that IP, or you want to stay in the good graces of the agency, so you put the extra resources in there. So if it does switch to fixed fee, I think many of you will say, well, I always felt financial risk. Now the IRS recognizes it and allows me to get R&D tax credits. So let's go through a math example. So there's something called the state startup payroll tax credit, which allows startups who aren't making money to use the credits to offset their federal payroll taxes. And so if you had 3 million of expense over a period of time, then typically you would have about 300,000 in federal credits. And those are credits that you could use against payroll taxes. You can also use those credits against your income taxes or capital gains. So if you're fortunate enough to be making money, then it's very simple. Use it against your federal taxes. If you're like the typical SBIR company, we don't make money. The only way we're going to make money is to exit this. And then there will be a huge tax event, but nobody will worry about it because they're getting a lot of money, except the person who says, wait, I got 3.4 million of federal credits and I'm in Pennsylvania, another 2 million in credits. So that's 5 million less in taxes we will pay. And that 5 million spreads a lot of joy. Then on the credit, the Pennsylvania credit, because most of you are in Pennsylvania, it typically is 10% of what your trailing 4-year R&D average is. Now if you're small enough, and many of you will be, that number is 20%. So, and typically our SBI companies are doing more every year because they're starting with phase 1, they're getting a phase 2, might get a phase 2B. All of a sudden, next thing you know, they went from $250,000 contracts to 2 million. So the numbers can get significant in a hurry. The state is great because it offers this credit. For good or bad, there's a finite pool of credits. There's about 60 million right now in Pennsylvania. And what does that mean? That means if they only have 60 million of claims at the state level, then all 60 million, everybody gets every credit that they calculated. If 120 million is claimed, then everybody gets 50% of what that number should be. But they're getting something. And on the Pennsylvania side, you can carry it forward for 15 years. So you say, hey, I don't have taxes now, but eventually you will. And the other thing is in Pennsylvania, which is pretty unique, is that you guys can transfer your credits. And you may say, all right, why would I do that? Well, because you could sell them to someone who has Pennsylvania taxes. So that way you may say, look, we're not making any money. It looks like I can get all these state credits. But now so I have no taxes, but now that you're telling me that I can sell them, color me interested. And so a lot of folks try to make sure they take advantage of that. And unlike the federal credits, the Pennsylvania credits doesn't go against your payrolls, but it's transferable. So that's pretty good. That's actually what we're trying to push at the Capitol Hill level, is to make it transferable. And why is that? Because the irony is the people who are doing the most R&D, who can get all these credits, can't use them. Because they're like, I'm not making money yet. Only time I'm going to be able to use these credits when I actually have this other really great financial outcome. That's not when I need the money. I need it now. Some of you may have heard that there was this new tax bill that passed. Jenna's going to walk us through it.
Yeah, so before the One Big Beautiful Bill passed in July, there was a pretty big headache around R&D expenses under Section 174. So the rule was you had to amortize your research spending, which means instead of deducting 100% of your research costs in the year that you paid them, you had to spread them out over several years. So for small businesses, If you got like a $1 million contract, this created a mismatch because on paper, you'd look like you had taxable income, or as Rick likes to call it, phantom income, because in reality, all of your money was going straight into research. You weren't actually getting a profit. So this was really stressful for SBIR companies, small companies, and we've worked with several of them to essentially keep them afloat during this time, because most of the work they, and I'm sure all of you do, is research under contract. So for those companies, there's a Treasury regulation that allows contract research costs to be deductible under cost of goods sold. So while also being able to claim the R&D tax credit. So a lot of small companies use that approach just to get by. But now for those who were amortizing, this new bill takes all that stress away, and starting in 25, the tax year 25, US-based R&D is back to being fully deductible in the year that you spend it. So you don't have to spread deductions out over time, which is an immediate cash flow benefit. And an important thing is Congress provided additional relief in the bill for small businesses. So if your company meets the gross receipts test, meaning your average annual revenue over the prior 3 years is $31 million or less, you can actually look back 3 years and amend those prior returns. So that means if you were amortizing in earlier years, you have a chance to go back and claim those deductions retroactively. So there are no barriers in claiming the R&D credit going forward, but also if you didn't claim the R&D credit in prior years, you can go back and amend to claim the credits that you missed to potentially get some pretty good refunds or apply those credits against future taxes. And one important caveat to keep in mind is that the bill did not change the rules around foreign R&D. So if your R&D is done outside the US, that still has to be spread out over 15 years.
Yeah, so that's pretty unpleasant for people who are in that situation. Fortunately, most of our SBR companies are not in that situation. So Jenna just spoke about how you can retroactively get these credits. So the question is, well, what would my credits look like? If you did 250,000 of expenses in 22, and then it moved to 500,000 in 23, and then you're at $1 million in 24, and this is not an unusual pattern that we see. If you went back and claimed credits, you could get 150,000 in federal credits. So that's very helpful. Jenna also discovered that if you're if you can file a superseded return for 24, even if you've already filed your 24 return. Now, that's only statement's true only now for C Corps. But many times SBIR companies have marked a tax status as a C Corp. 10/15 is the C Corp's deadline. And so Jenna, you want to kind of walk us through like what Congress did that would make this unusual situation possible? And I guess what I didn't say is the unusual situation is you can file an amended return, but really it's considered a superseded return, which means a new original return. And Jenna, can you kind of walk us through the benefits of being able to do that? And this is assuming you're somebody that either didn't claim the credits in 24, but you want them to go against payrolls, or you've been amortizing and you want to have immediate relief.
Yeah, so if you already filed for 24 and you filed as you were before, so you were amortizing, and you are a small business, you can take advantage of the superseded return provision in the new bill, which allows you to essentially file an amended return and expense everything for 24. And then you also have the option to just expense your prior year amortization, all of it on 24 as well. just to get the full catch up in 1 year. But if you were, I believe if you are a C Corp, the deadline has already passed because they included that in the
did they?
superseded return, as everyone had to file by 9/15.
Oh,
So that's kind
that's
of
why
like
we have
the
Jenna
tricky
doing
thing.
this.
Yeah, so unfortunately that deadline has passed, but if you haven't filed, you can still take advantage of the small business relief and deduct all of your 24 expenses on the 24 return, or expense everything from 2022 through 2024 on the return itself and get a 481 adjustment and recover all of that amortization.
Right. So if you're in that spot, you're going to want to talk to Jenna, because there's a lot of rules and mechanics that were introduced that have to be followed. So we just talked about what a superseded return. Jenna walked us through that. And then the history of the credit. And Steve, can you kind of walk us through that?
Sure, yes. So the R&D credit was introduced in 1981 in the Reagan administration. And so at that time, we were the first country to introduce an R&D credit. And since then, pretty much every major country has a credit. Most of them have a credit that's more advantageous than ours and more taxpayer friendly. So that's a big reason why you're always hearing in Congress when there's the tax bill in play, the R&D credits. They're talking about ways to improve the R&D credit, right? Because we want to be more competitive and keep our R&D in the United States and grow the R&D in the United States. So that was the main reasoning for the credit. And then over the years, there's been improvements to it. So in 2003, prior to 2003, most companies taking the credit were large companies with big R&D departments, pharmaceutical, what have you. And so in 2003, they introduced, or they eliminated the discovery test and leading industry criteria, which ultimately made the credit more available to small businesses. And now there's many more small businesses claiming the credit than large businesses. So that was really the intention of it. So in 2014, they made some additional changes that were taxpayer friendly, and one of those was they made the credit available for internal use software as well as external use or SaaS software. If we can move to the next slide. So in 2016, this is most impactful for startups. So the PATH Act of 2016 made the credit, number one, permanent. It had always been a temporary part of the tax code prior to that point. So now it's a permanent part of the code, but it also made the credit more available and usable for startups by allowing startups to use the credits against payroll withholding. As Rick said, most startups don't have a lot of income tax, if any at all, to use the credits against. So this allowed them to use it to monetize the credits more in the near term. In 2017,
sorry, let me go back.
The Tax Cuts and Jobs Act introduced, eliminated the opportunity to immediately deduct R&D expenses, but that was, as Jenna and Rick mentioned, that was addressed in the OBA bill that recently passed, and now that's a non-issue on a go-forward basis. In 2022, the Inflation Reduction Act actually increased the payroll startup tax credit from, initially it was limited at 250,000, and it doubled that to 500,000. So again, that was another plus for startups.
And then the credit computation for startup companies, Steve's going to walk us through this.
Yeah, so to qualify as a startup and use the credits against payroll withholding, And that's federal. The federal credits are used against federal payroll withholding. In order to qualify, you must have less than 5 years of gross receipt history, and less than 5 million of current year revenue. And so long, and your gross receipt history starts the first year you have any kind of revenue running through your entity. And as we mentioned, you're able to use up to 500,000 in credits per year against payroll withholding. 250,000 offsets Social Security tax, and 250,000 can offset Medicare tax. And so, how this would look in a real life environment. So, we're using a biopharma company, a C Corp, that started in 2023 with net operating losses, right? So, starting with tax year 2025, since that's the current year most of us are in from a tax perspective. This company had 850,000 in qualifying R&D expenses that generated. You can typically expect about 8% of your qualifying expenses as a federal credit. So this company produced about a $68,000 credit on those qualifying expenses, and they had about $750,000 in annual payroll. So the way this works is when they file their 25 return, which will be in 2026, they make that election on the return to use those credits against payroll withholding on a go forward basis. So they would start using those credits in 2026. So the 68,000 they generated, they had 850,000 in payroll in 26, and they were able to offset 65,000 of those payroll taxes. So they were able to monetize the 65,000 of those credits in the first year. And then again, they generated another 80,000, and so they had 82,000 that carry forward. So the credits carry forward for 20 years. So you just keep accumulating them, and you can kind of see how the math works out year over year. So over the first 4 years, this company was able to offset $218,000 in payroll withholding. So these are required payments. And so that's just a way that you're able to monetize those as a startup, in the near term. Qualifying activities that we look for, the conceptual development, design, engineering, any kind of software development, experimenting with new materials, designing molds, fixtures, jigs, prototyping and testing, manufacturing processes. Anytime you're building something new, developing something new, improving upon something, the main thing is these activities must occur in the United States. So to the extent you're offshoring any of this activity, that would not qualify. But if it's occurring on U.S. soil, it will qualify. If it's occurring in Pennsylvania, it will qualify for the Pennsylvania credit. If it's in another state, it could trigger other state credits as well.
I'm going to go to the next slide. I'll take that as a yes. There we go.
So the 4-part test. So when we take on a client and we qualify a project, we must be able to prove out that that project meets all 4 of these criteria. So the first test is the permitted purpose test. And this states that the activity must be intended to develop or improve a business component. So again, developing a product, improving upon a product, developing software, improving upon a manufacturing process, as long as you're doing it from any one of these areas: functionality, reliability, performance, or quality. So aesthetic improvements would not be includable. And the second test is the technological in nature test. This states that you must rely on one of the 4 hard sciences in your project. The third test is the elimination of uncertainty. And so at the outset of the project, there must be technical uncertainties or technical unknowns that exist. And the fourth test is the process of experimentation and the trial and errors and iterations occur that prove out that there were uncertainties that existed in the project. So once you have a project that meets the criteria, you can kind of see the expenses that generate the credits at the bottom left-hand corner. So again, these must be U.S. expenses. So any U.S. wages, supplies, U.S. contractors that are used throughout that project would be includable in calculating the credit. In a software environment, if you have cloud hosting fees that are attributable to the software development, those expenses would be includable as well. And again, if you add up all those expenses, you can realize a credit typically around 8% of those qualifying expenses. So what this looks like in a software environment. And so the green boxes are where R&D will typically exist. You know, the technical sales, and most people wouldn't realize this, but in a sales environment or anybody that's client facing in the organization, if you're meeting with clients to determine what their technical needs are or technical improvements that need to be made to the product or software, you know, and then those ideas are brought back in-house to the design development folks, the percentage of that person's time can be included, even if they have a sales title or they're the owner of the company. The R&D credit is not title specific. The rules are more activity specific. So irregardless of the title, if those activities are occurring, qualifying expenses could be occurring. The requirements, you know, obviously use cases, activity diagrams, design, activity, development activity that are more obvious for R&D, right? And then once the initial release occurs, and you're getting in more of the bug fixes and maintenance activity, that's when the R&D would stop, right? But then when you release new versions and new developments, or you get feedback from clients on, hey, we need this functionality or that functionality, and you go back and again, you go back to that permitted purpose test. If you're making product improvements from a functionality perspective, quality perspective, then that's where the activity will pick back up again. And we show the different layers where the credit is not just you know, derived from those individuals that are directly involved in the R&D, but those that are also technically supporting the R&D. The sales is one example of that. And then those that are supervising the R&D. So owners of the company are sitting in planning meetings, things of that nature, and contributing, you know, from a technical perspective, percentage of their time can be includable as well.
Jamie, can you spend just a couple of minutes talking about you know, the R&D tax credit computation? Not everybody's familiar with this base amount concept, and the alternative simplified method. We're not going to bore you guys with everything, but he'll give you kind of a flavor for what it looks like.
Yeah, so essentially, because the credit is, the objective at least is to benefit increases in research, but also just to preserve the research environment in general. The government quickly realized that the regular credit calculation was a little complex and required, you know, kind of significant movement year to year to generate, you know, a beneficial credit. So significant growth in your R&D activities. When you know, in reality, you can have consistent R&D year in year and still be contributing in the way that Congress desired when they established these programs. They established the alternative simplified as a different approach where the base period is a little different, and it gives you some alternatives here to try to squeeze the most out of the credit program if the regular credit was not the best alternative.
And generally, that's where we say it's 8 to 10%, but with the alternative simplified method, if you have tremendous increase in a year over your prior years, it can be as high as 14%. And that's not an atypical experience for SBIR companies, that they step up several levels in just a year or two. We've been talking about all the good things about it. Steve's going to kind of walk us through the gotchas.
Yeah, whenever we're evaluating a client, and we provide an initial, upfront assessment, complimentary, to determine if they're checking all the boxes, right? And these are some of the boxes you need to check. Number one, are you in a position to utilize the credits and monetize them in the near term? And so that's something that you definitely want to consider before you pursue the credit, especially if you're paying another party to calculate the credits. You want to, we usually want to have a conversation that includes the tax preparer and get a sense of, okay, what's the strategy to use these in the near term? If there's not one, may not be the best use of resources. The other pitfall could be control groups. So if there's common ownership in another entity, those entities must be considered when calculating the current entity's credits. Any acquisitions or dispositions in a tax year can change the landscape of the credits as well. So those must be considered. Passive shareholders, that's less of an impact now with AMT being less of a play, but that's something that must be considered as well. Funded research we talked about. Under funded research, we must determine rights and risk. And a documentation, we'll touch on this more at the end, but companies will often ask us, well, hey, we haven't done a good job of documenting R&D or tying cost to projects and tracking hours and things of that nature. So that doesn't preclude you from claiming the credit. You just need to have a good process in place for using what the information you have and turning that into what the IRS is going to be looking for if they question the claim. So our process for both calculating and substantiating the credit, up front, as I mentioned, we provide a complimentary assessment to touch on all the things we just covered. And should the client have a good fact pattern and want to move forward with the credit, we provide an engagement and proposal. We give an estimate of how much credits are there, how much they can use in the near term. And then kind of our phase two is once we're under contract, we do field work. A lot of times we may conduct a site visit in a manufacturing environment. In a software environment, that's less needed. But we gather the information, conduct interviews of key individuals. And what we're putting together is detailed write-ups of, as I mentioned, I showed the 4-part test. We're documenting how each project meets the 4-part test and doing detailed write-ups of that, how each individual's time is contributable to those projects and how their activities meet the 4 tests. And what we're doing is preparing should the IRS ever question this claim. So some of this documentation is required with the return now. So some of it's prepared if the IRS ever digs in and wants to see more. So we're kind of building that defense should it ever happen. Although, you know, less than 3% of our clients are selected for audit each year. It's not a high risk of audit, especially with smaller startups, but we're preparing each claim as if it's going to be audited. If phase 3 is if the claim is audited, our engagement includes full audit defense all the way through the appeals process, and Jenna and our legal team kind of leads that that process with the IRS.
And the reason why we're so keen on making sure there's great documentation, we have a bunch of engineering writers, so we help produce that, which is we see everybody as our neighbor, and we wouldn't want our neighbor to be at risk. And we want to have everybody feel as confident as we do that this is not going to blow back, that when you get credits, you keep credits. And what's the old saying, an ounce of prevention is worth a pound of cure. So speaking of cure, there's a lot about doing it the right way, and Jenna will take a few minutes to kind of walk us through those, some of the R&D filing requirements.
Yeah, so we can look at what the IRS actually expects from you when you file an R&D credit claim. So the IRS has always felt like people are overclaiming the credit, and I think they're getting a little more strict about it in the most recent years. So the new filing requirements are just an evolution of them upping their game by adding the specificity standard, because in their perspective, if you can't provide all of the information that they're asking for, they think that you're claiming too much. So they're just asking for more detail upfront, which just helps them review claims faster and more efficiently. So when filing a credit claim, you need to meet that specificity standard, which basically says your claim needs to be specific enough that an IRS agent can clearly see what you did, why it counts as R&D, and how it ties to your expenses. So in other words, you can't just say, like, we improved our biotech process. You need to describe what you tried, why it was uncertain, and what expenses were connected to that work. They want to see face validity, meaning the claim looks real and defensible at first glance.
Jenna, we had a question that I think relates to this. Vanya asked what documentation is needed to claim portion of the GM/CEO/PM's time on managing projects.
Rick, you might have a better answer for this, but I believe we ask for like any kind of time tracking documentation for that.
So for those who had the time tracking, then we ask for that. For those who don't, we'll interview them to understand about how much of their time went towards the research, either supervising the research or not. But then from an activity standpoint, what we'll do is first describe how the activities were R&D, and then show that their efforts are part of that project. And they can either be, as Steve said, just supervising the work. But for most of our SBIR companies, the principal investigator is the owner. So they're billing time to projects all the time. And if we're able to deem the whole project's eligible for the R&D tax credit, then all their time counts. And then what does the IRS want to see? You guys will go, wait, Rick, this is all kind of academic, pun intended, because our contracts say research on it. NIH gives us a research award. So there really isn't any need to do anything. The IRS looks at it differently, because they say, well, just because the NIH says this is research, we're going to decide whether or not it's research that's eligible for the credit. So, and typically, and I'm kind of stealing some of Jenna's thunder, typically, IRS folks are our neighbors. So they're just people. And what do we know about people? We always say how their work can't be that hard. You're putting pills in a bottle, you're a pharmacist. Why does it take forever? Until you're the one doing it. And you go, there's a lot could go wrong. I need to be careful and do it exactly right. That's human nature. So they say, yeah, you're a scientist, you're doing work, but probably only the very beginning of your work counts, like the theoretical model. And many times that'll happen in the proposal phase. And they'll say everything after that is just executing it. And you're like, well, hold on a second. If you had to do it, you would see all along the way as we thought we had the right answer, and then lo and behold, we didn't. So we had to do this other approach, and we kept doing that. And that didn't stop until we got to the finish line. And so the key there is, and that's why we have a whole bunch of engineering writers, is through interviews and documents, we're able to tell that story in language that allows the IRS to say, hey, okay, I see how this meets the four-part code, the four-part test. And it's in language that I can understand, because many times these aren't scientists looking at it. So you want them to be able to understand why you've been doing science for 20 years, but you're now saying it's still R&D. So that's the way to make it safe. Oops, sorry. There we go.
Okay,
Jim,
so
go ahead.
for the updated form 6765, which is the form that you fill out to actually claim the credit, the biggest change is section G, which was added, and now it's required for 2025 filings. And this is kind of a breakdown of what the IRS wants to see for each R&D project, or what they call a business component. So a short summary of the project, what your objectives were, the technical challenges you faced, and then all of the costs tied to it, like wages, supplies, and contract research. So, and importantly, this has to be reported at the entity level, meaning the company as a whole, not just by project team. This might sound like a lot of work, but I assume that most of you are likely already tracking this information. And if you've applied for grants or reported to your investors, you're probably already writing down your objectives and the challenges that you face. So this form is basically just asking you to reframe that information for tax purposes and for the IRS to easily understand what you were doing. So the better, like Rick said, the better you can structure your R&D claim upfront, the faster the IRS can review and approve your credit.
Yes, and remember that these are our neighbors, and what do you do for your neighbors? You want to make it easy for them, because you make it hard, you don't see the best side of your neighbor.
And then just quickly covering amended claims, there's a chief counsel memo that came out that just explained how amended returns are handled. So this matters if you ever realize you missed claiming credits in prior years and want to go back and claim those. So this memo just says that amended refund claims have to meet the same level of detail as new filings. So just like the section G that we just covered, you have to include project by project detail. So again, objectives, technical challenges, and all of your related expenses. And the IRS does allow for a transition period to help companies adjust to it. So if you file an amended return that might be missing something, you usually get a 45-day perfection window to correct it. But as we recommend, the safer move is to just have everything ready to go up front, so you don't risk missing that window and having to scramble to pull everything together. Just as an attorney, it makes everything easier for both of us if a client has strong documentation at the time of filing. It just makes my job a lot harder if we know a client is actually doing R&D, but they don't have the right documents to prove it. It's like really frustrating. Researcher notes don't usually have enough to establish validity, and the IRS is less likely to accept explanations after the fact. So having everything ready is really important to uphold your credit. And then Rick kind of touched on this already, but one of the biggest pitfalls people run into is thinking that having a signed research contract alone proves everything is eligible for the credit. Unfortunately, the IRS does not see it that way. So having a contract, of course, is a good start. but the IRS is looking at the actual work being done, not just what's written in the agreement. So there's that theoretical model stage, which is the first 10 to 20% spent building the initial proposal. So the IRS thinks everything else after that is more so just the taxpayer executing on that, and it's not true R&D. So from their perspective, most of a contract's budget, like 80% or more, is usually for execution, routine testing, or production support. So they assume only a small percentage is actually uncertain experimental R&D that qualifies for the credit. So again, the key here is having strong documentation. You need written substantiation that shows which part of your contract work was experimental, how it meets the 4-part test. Basically, you just shouldn't rely on the contract alone. You need to break out all of your activities and your costs tied to actual R&D.
So this is a nice segue into our compliance. And we, as you can tell from what we talked about, take it very seriously. And Steve will walk us through our approach.
So as I mentioned before, not having good project documentation does not preclude you from claiming the credit. We take the documents our clients have and turn them into what the IRS is going to be looking for in a format that's easy for them to follow. And so what this looks like is, and we touched on this mostly in the other slide as well, but this is kind of what the substantiation looks like that we put together. That's what we call our digital audit library. And so in that, it includes the workbook with the calculation and all the methodology we use behind the calculations, the project level write-ups that we talked about, the R&D matrix, which shows, who did what and how their activity meets the 4-part tests. And then, Jenna writes up legal briefs on our tax positions that we're taking in a particular study, and all that's included in the digital audit library.
Yeah. And that's what we battle tested. We ran one credit that was a $12.7 million credit past the IRS. And what we do, and this is what every attorney says you shouldn't do, is IRS asks for some information. They'll ask a few questions. And we say, well, we got this digital audit library that has all these things that Steve just mentioned. Can we just give that to you? And they're like, oh, wow, we're used to taking like a year to get all this stuff. And that $12.7 million audit lasted 4 months. It was 3 months was IRS crickets because they said they needed time to go through it all because they're not used to getting it. And then they thanked everybody. They thanked the client and thanked us for doing such a great job and making it easy for them. That's what great documentation produces. So we really appreciate you guys giving us some time. We hope that this was helpful and that it kind of made sense to you. And then that maybe you don't remember all the details, but you get some of the major concepts. So you kind of know whether or not this is something worth investigating. Plus, if it is, then Steve's going to probably drop a link in the chat so that you could set up time and we'll just talk to you about your situation. That usually helps people decide what they want to do. So let me hand it back over to you, Jamie. I appreciate you setting this all up.
Yeah, thank you. And I know we're very short on time, but if you have just a 60-second introduction that you can share, and while people are trying, thinking of any other questions.
Sure. So thank you for that presentation. It was very interesting. I wanted to point out two things that have to do with the research and development credit. I work for MVM Associates. We've worked with a lot of Pennovation companies and some PCI Ventures companies helping you locate grants and tax credits. In relation to the Pennsylvania Research and Development Credit, there's an application deadline in December. So if you wait to deal with it when you're filing your 2025 taxes, you'll miss the application deadline. So please be aware that if you want to claim the Pennsylvania credit, you need to do it prior to the end of the year. Second of all, I wanted to note that we also sell credits. So if you do work with Rick and his team, for instance, to get a Pennsylvania credit or that is sellable and you're interested in selling it, we can work with you to sell the credit. And last but not least, real quickly, I just wanted to mention that there are other programs with sellable credits. The KIZ program has a deadline approaching in December. It is great for companies 8 years and younger that are innovative. Many of the Pennovation and PCI Ventures companies will qualify. If you want to talk to me about the program, Jamie has my contact information. Thank you. Was that quick enough?
Yes, thank you. And again, this session has been recorded, and we will circulate the link once that's live, and we can also include in our follow-up information about the Sycamore Growth Group as well as MBM Associates.
Great. As Rick mentioned, I put a link in the chat for anybody that wants to schedule time if you had additional questions or want to assess your specific situation.
Perfect. Thank you so much. Thank you, Rick, Steve, Jenna, and Jamie for that presentation.
Well, our pleasure. Thanks for inviting us. We hope this is helpful.